want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to the DIY Investing Podcast. My name is Trey Henninger and I'm your host. This week I have a special guest on the show, Value Stock Geek. Value Stock Geek originally appeared as a guest on the podcast during episode 49 of the show. He writes about his investments at his blog, valuestockgeek.com. Welcome to the show.
Hey, thanks for having me.
So last time on the show, we discussed your investing history and your active investing strategies. And today we want to discuss your views on passive asset allocation. So to begin, why would an active investor like yourself have a passive asset allocation strategy?
Right. So I set aside about $50,000, which is the account I track on the blog, where I pick stocks and I pursue an active investing strategy. I hold cash when I think the market is overvalued and I can't find securities. I'm making active bets. I'm researching companies. I'm trying to project the future. At the same time, I'm really conscious of the fact that it's difficult to predict the future. It's difficult to predict which stocks will outperform. And at the same time, while I'm picking my spots within an active stock strategy, my returns are still strongly correlated to the performance of the U.S. stock market, and in particular, the performance of U.S. small cap value. So I really wanted a bulk of my net worth to be in passive, diversified strategies across different asset classes. And the whole thinking behind that is I'm not trying to predict the future. I realize how hard that is, and I basically want to have different elements of a portfolio that will perform in different kinds of economic environments. I first started getting into this because I wanted to begin pursuing financial independence. In my 20s, I was a bit of a knucklehead and I had some debt. I got out of that situation. Right now, I have about 6 years of expenses saved up. I'm 37. I'd like to be financially independent by the time I'm 50. And I really spent a lot of time thinking about a good passive strategy to put a bulk of my savings into. So I looked at the advice of a lot of the fire bloggers like Mr. Money Mustache, other bloggers that are out there. I think they get a lot right. In particular, I think their key insight is that a really high savings rate is the most important thing to your investment results. It's probably even more important than the particular strategy that you pursue. A good book out of that whole movement is Your Money or Your Life, which talks about how to think about money, how to think of it less in terms of a temporary pleasure thing, a dopamine release when you spend money. It's more a product of your money is more a product of your time, the time that you spend trying to earn it, and you want to really optimize the way that you spend it. With that said, a lot of these fire bloggers are pursuing 100% U.S. equities as their investment approach, usually through a mutual fund like VTSAX or an ETF like VTI. I don't really think they're conscious of all of the problems that are embedded with that approach. For instance, you can have lost decades, the 1970s and the 2000s. You had flat or negative returns when you take into account inflation. U.S. stocks can get swept up in bubbles. Probably the ultimate example of that would be in the U.S., it would be the dot-com bubble that we experienced in the 90s, which was a big part of what led to those negative returns over the 2000s. To take it to a more extreme level, you could look at Japan in the 1980s. The U.S. is nowhere near those kind of valuations. At that point, I think Japan got up to a CAPE ratio of 100. Right now, the U.S. is at about 30. But it just gives you an example, because in Japan, because it got up to that ridiculous CAPE ratio, it took 30 years to get back to a normal valuation. And those investors spent 30 years, which for a lot of people is the amount of time that they're saving and investing for retirement, which is a long time to have negative or flat returns, and it can really destroy your results. U.S. stocks can also be very volatile over time. You can have 50% drawdowns. And there are risks embedded with making a bet on a single country. What if the U.S. changes the economic model that made all of its wonderful returns possible? What if there's some kind of political event that changes all that? What if the U.S. dollar collapses? What if our deficit spending catches up with us? I mean, if you look at an extreme situation, you could look at countries like Russia or China, where when they went communist, their equity markets essentially went down to zero. I don't think it's going to happen here, but I really wanted a portfolio that wasn't just 100% U.S. equities and could diversify my savings among a bunch of different asset allocations and achieve my goals, which is no lost decades, really limit my maximum drawdowns, avoid bubbles, reduce volatility. That's basically was my objective there with the bulk of my net worth.
So it's really driven by the pursuit of financial independence and kind of hedging the downside risk if you're not as good of an investor as you want to be. Is that an accurate way of describing it?
Pretty much. I mean, everybody who is pursuing an active strategy thinks they have it figured out. I'm very conscious of the fact that I probably don't have it figured out, and they probably don't either. So I think it's best to have a good chunk of change set aside that is more passive, but at the same time is very diversified among a lot of different asset classes.
Yeah, that makes sense. I hope my audience is aware of the fact that I also don't think I have everything figured out. You know, we're all here to learn together, but hopefully I haven't given that wrong impression. So I think it's interesting because I think that this applies to a lot of investors, where even if they're listening to this podcast or other investing podcasts and they're interested in active investing and buying in some individual stocks, even if it's not all their portfolio, that sometimes they're just going to be stuck buying some passive strategies and they need to be aware of it. For instance, if you're in the US and you have like a 401k, most 401k providers don't have the ability to buy individual stocks. Some do, certainly, but even the most active investors might have money that's stuck in a passive strategy. So I guess besides 401k investors that maybe can't do anything else, you know, who do you believe should focus on passive strategies to the exclusion of like an active strategy? Or who do you think that this kind of conversation is going to be most helpful to? You know, like what's our target audience today?
I think everybody should have some passive strategy. They should have some set of money set aside that's their safe money, that's their safe haven. And they really want to take advantage of the diversification that can happen and the benefits of diversification, because the benefits of diversification are really just tremendous. I mean, if you were to take a really basic portfolio, say it's 50% U.S. stocks, 50% U.S. bonds, the benefits of diversification, like David Swenson, he says it's the only free lunch in investing. And he's right. Like if you take that basic portfolio, you get a result that's better than the sum of its parts. So since 1987, U.S. bonds have returned 5.86%. U.S. stocks have returned 10.34%. If you were to average those two returns together, you get 8.1%. But the actual result of having that portfolio, rebalancing it every year, is 8.47%. So you get a result that's better than the sum of those parts. And the same is true in terms of the benefits that you have with volatility. Bonds, they have a 3.81% standard deviation. Stocks have a 14.95% standard deviation. If you were to split those in two, you're going to get roughly, 9.375% if the portfolio were just the average of those two. The actual result, because those asset classes are delivering the returns at different times, you're constantly rebalancing it, you're buying more stocks when they're cheap, you're selling stocks as they go up every year, your actual standard deviation is 7.83%. So it is a real free lunch, and it's a little crazy to just leave that on the table. There are so many benefits to diversifying like that. You also get a portfolio that's behaviorally easier to stick with. So it's real easy for an investor to look at a back test, look at the performance of U.S. stocks in, say, 2008, and they see a 50% drawdown. It's real easy to look at that when you don't have real money on the line and say, well, I would have bought and hold and I would have stayed true to the faith. I think it's really different when you have a significant amount of money saved up and you see half of it evaporate to think that you're going to behave rationally. A lot of people, when that happens, what they're going to wind up doing is selling at the worst possible time. Whereas a more balanced portfolio can help you stay more disciplined and help you actually realize the returns of those different asset classes. Even like the simple kind of portfolio I described, 50% stocks, 50% U.S. bonds, instead of a 50% drawdown, you would have had about a 20-25% drawdown. And it's a lot easier to behave rationally in that kind of situation than it is in a kind of 25% nightmare scenario. And it's not only bonds that can provide diversification. Even when you combine two risky asset classes, you get a result that's better than the sum of its parts. Like, for instance, if you take REITs, since 1994, REITs have delivered a 9.58% rate of return. The U.S. stock market has delivered 10.04%. You combine those two asset classes, you actually get a better result. You have a higher return. You get 10.04%, and you combine the two into a portfolio. So it's better than both asset classes on their own. And you also get the benefits of reduced volatility. U.S. stocks have a standard deviation of 14.76% in that time period. REITs have 18.94%. You combine them in a portfolio, you get that down to 14.89%. So pretty significant reduction in volatility instead of just combining them together. So you also get the benefit of different asset classes are providing different returns at different times. So to look at the world in terms of asset classes, to realize your exposure to a single asset class and realize that that's something you kind of want to hedge against, you really get just tremendous benefits all around. And it's benefits that's greater than the sum of the parts. Swenson's right. It really is a free lunch.
So to dive in on that, when you're talking about the benefits being greater than some of the parts, you mentioned to a large degree kind of two items. You talked about returns and you talked about volatility. In basically, it's accepted in the mainstream that volatility is risk. Do you ascribe to that same philosophy? I
don't. But it is a good measure of how much Pepto-Bismol you need when you're looking at your regurgitation.
Yeah, so it's not exactly risk, but there's something in there that can cause people to make bad decisions, basically.
Exactly, and I think a person has to be honest with themselves and think behaviorally, how am I going to react to that volatility? Now, maybe you're kind of a super investor like Warren Buffett or Charlie Munger, where when they talk about it, they say, if you can't take a 50% drawdown, you don't deserve. Actually, it's Munger who says that if you can't take a 50% drawdown, you have no business investing in stocks. I think that's kind of an extreme approach to it, and I don't think people can handle the volatility that they think they can. It's real easy to say, after, say, a decade like U.S. stocks just had, that you're not concerned about volatility, you're not concerned about drawdowns. But I think the reality of when you're in that foxhole and you're facing that serious volatility, serious drawdowns, you want to have an approach that's where you can act rationally in those situations. And I think diversification can really help people achieve that.
Well, I think it's a good point when you're talking about the super investors or just this idea of sitting here today. We're at the beginning of 2020 and this market's been on a 10-year run, I guess over 10-year run at this point. And if you're looking at it, it's like, oh, well, 100% equities, the volatility is not that bad. It's really easy to get complacent in today's time. And then during the times like a 2008, you're not going to be sitting there able to call up Warren Buffett, who's talking about volatility and saying it's no problem, or you're not going to necessarily be able to, talk to the two of us sitting here saying, oh, well, you can work through volatility or whatever during the time where your portfolio on your screen says it's negative 40 or negative 50. And you're not going to see it in those percentages. A lot of times you'll just see it as, oh, I'm down $100,000 or $200,000 or whatever the number is. And you see that loss. So I agree.
Right,
I think.
100.
Go ahead.
Yeah. No, yeah, I completely agree.
So when we think then kind of, okay, diversification kind of gives us this free lunch. It kind of helps you get some benefits of different asset classes. I think that's a good lead into talking a little bit about what your preferred asset allocation strategy is. So like, what are you doing with your passive portion of your portfolio?
Sure. So I looked at a lot of different kind of lazy allocations where you just pick a asset allocation, you rebalance it once a year. And there's a lot of different approaches. A really good resource if you want to look at different approaches is a website called portfoliocharts.com. It's made by a blogger who has created a great resource where you can go and backtest different allocations. And there's a lot out there, and I've looked into a lot of them. There's the classic 60-40, so that's 60% U.S. stocks, 40% U.S. bonds. And that's a really great portfolio. You have bonds. They tend to do well when the Fed is cutting interest rates. The Fed is typically cutting interest rates during a period of time when U.S. stocks are getting clobbered. And you have this great relationship between those two asset classes. When U.S. stocks are going down, your bonds are going up. When your bonds are going down, when the Fed is raising interest rates, it's normally during an economic boom, and your U.S. stocks are doing really well. And that's just a great classic way to diversify. Vanguard has had their Wellington Fund, which is basically that allocation. That's been going on since 1929, and it's served many investors very well. I've also looked into Ray Dalio's All Seasons allocation. That's a portfolio that is predominantly long-term bonds. I think that gives you a lot of protection when there's a big drawdown. There is the David Swensen allocation, which is pretty much what I do with my 401k because I have to use market cap weighted options. Swensen's allocations are roughly 25% U.S. stocks. He recommends putting about 15% in international developed, about 10% in emerging markets. Then he's adding in some tips, a total U.S. bond market fund, and then a pretty significant allocation to REITs as a real asset. There's the Bogglehead 3-fund model where you're buying U.S. stocks, international stocks, and a total U.S. bond fund. I felt like there were a lot of different problems with those allocations that I didn't really like, where for me, I'm a value guy, and the academic research tells us that going for small capitalization value stocks is really the best long-term strategy that there is. So I wanted an outside allocation to small cap value. At the same time, I don't want to have a home country bias, so I want to own some international equities. Owning some international equities is a big help because one of the big benefits of an international allocation is currency. And one of the nice things about the way that interacts with U.S. stocks is that foreign currencies tend to do well when the U.S. stock market is doing poorly. U.S. stock booms tend to be correlated with the U.S. dollar being very strong. So having that yin and yang in your portfolio of having U.S. stocks and having international stocks is a good way to do it. So I wanted my portfolio to include U.S. small cap value. I also wanted to include international small cap value. So those were two asset classes I wanted to have in there. I also wanted long-term bonds in there. So the big benefit of a bond allocation is that bonds go up when the U.S. stock market's going down. And I figured that I wanted to focus on the segment of the bond market that performs the best during those environments, and that would be long-term bonds. So, for instance, long-term bonds were up nearly 20% in 2008, while U.S. stocks were getting crushed.
Can you define long-term bonds? What's the duration there?
Sure.
10 years, 30 years? What are you talking?
Like U.S. government bonds that are typically in excess of 10 or 20 years.
Okay.
Those are the asset classes that do the best. Another thing I really wanted was some inflation protection. So a good way to do that would be Treasury inflation protected bonds, or TIPS. So I have an allocation to TIPS, and the way that TIPS work is the principal on the TIPS tends to get adjusted with changes in the consumer price index, and then meanwhile you're getting paid an interest rate, like a coupon rate on top of that. So those are U.S. bonds with inflation protection built into them. That's important because the biggest risk of owning bonds is inflation. U.S. bonds from the 30s through the end of the 80s, during the great inflation that took place in the 70s, bonds were in they never had a large nominal drawdown, but they had a real drawdown of nearly 50% because inflation ate into those returns. So that's why TIPS, I think, are a great allocation in a portfolio, because you can own bonds but also have that inflation protection built into it, which is one of the biggest risks in owning bonds. I would like to be 40% long-term bonds, so I could really have a lot of protection in the event of drawdowns, but long-term bonds are going to really suffer in an inflationary environment like that. So I also considered owning gold as some inflation protection. I've been influenced a lot by Warren Buffett, by what he says about gold, where he says it sits in a vault, doesn't earn you any interest. I pretty much agree with him on that, but stepping away from my biases here, gold, a small gold allocation, like a 10% gold allocation, actually does do a lot to enhance returns. A lot of that is because gold tends to perform really well during an inflationary period like the 1970s. Gold was the best asset class to own during that period of time. It can be a terrible allocation to own when inflation is coming down, like it was in the 80s and 90s. Gold had a pretty significant drawdown. But yeah, I don't see anything wrong with having a small allocation there. But for me, I picked TIPS as my inflation hedge. So we've got U.S. small cap value, international small cap value, TIPS, long-term treasuries. And then the last thing that I added in there was REITs, or real estate investment trusts. So REITs are another great diversifier. A big reason that they're a great diversifier is that they're required by law, in order to reduce their taxes, to pay out roughly 90% of their profits in dividends. So while U.S. stocks tend to go through tremendous periods that are of ups and downs, euphoria, and despair based on where multiples are going. So you could have periods of time when multiples are up to 40 on a CAPE ratio basis. You could have times when they're down in the single digits like they were in the early 80s. REITs are kind of just slow and steady. They're going to give you that regular dividend payment. It's usually a really high dividend yield. And it kind of keeps you away from the ups and downs of the U.S. stock market. The only exception to that is 2008, when REITs had a very significant drawdown because of the real estate crisis. Another big advantage of owning REITs is that they also offer some inflation protection. REITs did very well in the 1970s, and that's really because real estate does well during an inflationary period, the replacement cost of those real estate investments will be going up while price levels are going up. So there's some built-in inflation protection. You get some income, and that's the portfolio I decided on. Was 20% U.S. small cap value, 20% international small caps, 20% REITs, 20% long-term treasury, 20% tips. And when you put that into a portfolio and you just equally weight them, you actually almost get to the U.S. stock market's rate of return, but you get there with less volatility. You lower your drawdowns. The max drawdown on this portfolio is about 30% versus 50% for the U.S. stock market. And that 50% drawdown was a pretty unusual event, I think. That was in 2008. If you go back to a time like the early 2000s when U.S. stocks had another 50% drawdown, this portfolio delivered consistent, constant returns in 2000, 2001, 2002, and then it participated in the entire bull market from 03 through 07. So it's kind of, I think 2008 was kind of unusual in that every asset class was clobbered with the exception of bonds. And I think that this portfolio will deliver return in most environments, and that was certainly the case from the 70s all the way through 2007. I think the worst year for that portfolio was negative 7%, and it got you there with so much less stress and so much less volatility.
So we have basically you've kind of have a 60-40 portfolio, 60% equities, 40% bonds, but you've broken it down into subcategories that kind of have some additional benefits over just a true, like an S&P 500 for the 60 and a long-term bonds for the 40. Is that an accurate statement?
Yeah, that's 100% accurate. So with the equity, you're going towards the equity slice that performs best, that small cap value.
Yeah.
With the bonds, you're tilting towards the bond categories that are going to do best in a big drawdown, which is long-term treasuries. And then you have some diversifier real assets in there like REITs, which also help reduce the volatility and deliver a more consistent return.
So you're really trying to capture benefits from rebalancing then, right? I mean, because that's the driver here that, you talk about, okay, you're going to have similar returns to, let's say, an equity portfolio with less volatility, and you're getting that because during downturns you're buying more. Is that accurate?
Yeah, that's 100% accurate. So think about the end of 2008. Your stocks have been absolutely crushed. Your bonds have gone up a little bit. If you're rebalancing once a year, say you rebalance December 31st, 2008, you're buying more stocks and you're selling your bonds just systematically. That's what you're trained. That's what your portfolio is designed to do. If it's the year 2000, you are also selling your stocks as they've gone up in value. So when the stocks are whatever asset class is doing well at the end of the year, you're going to be selling it, and whatever asset class has done poorly, you're putting more into it, and you're just systematically taking a contrarian approach. And I think that's the reason that most diversification strategies work really well, is because you're systematically you're owning everything, so you're exposed to everything, but you are putting more money into the asset classes that recently did poorly. You're always probably going to have something to hate in your portfolio. You're never going to be all in on the best performing thing, but you're also never going to be all in on the worst performing thing. And as you rebalance, you are taking a contrarian kind of value investing approach, and you're putting more money into the strategies that suffered the most.
So I want to dive in on 2 points here. The first is rebalancing. It's kind of a two-part question. So you have rebalancing, and then you have this idea of a lazy portfolio. So how much of the annual rebalancing strategy is based upon kind of it being lazy versus being optimal? So is an annual rebalancing more optimal than, say, monthly, quarterly? Does it matter whether it's December 31st or you do it on your birthday? Or I mean, how do you think about annual rebalancing other than it's often talked about? Have you looked at kind of the core principles behind why choose annual?
I think that annual gets you there. I don't think it really matters if you do it monthly. I was reading some research done by Corey Hoffstein recently where he was talking about rebalancing luck. So, for instance, if there's portfolios tend to do better if you rebalance at the end of the year, and he was recommending kind of normalizing that by rebalancing multiple times of the year. For an investor like myself, I think a year works best because, and I don't think it really matters when you do it, but a year tends to work best because long-term capital gains are charged based on a year. So if you sell after a year, you're going to be charged a lower capital gains rate than if you rebalance more frequently. And I think that's done best with, we can talk about this later, but I think it's done best with ETFs. Like I invest entirely in, except for my 401k, I invest entirely in ETFs. And that way, when you do sell after a year, you get charged less in capital gains taxes. And ETFs also have special tax advantages over regular mutual funds.
Gotcha. So it captures some of those tax benefits as well.
Right. It captures those tax benefits. It's easy to do. So that's another benefit of it. It's a true lazy portfolio.
Well, how long does it take you to do it?
That,
you say it's lazy. How long does it take you to rebalance once a year?
You could do it in 10 minutes on your Schwab account. Just go in, buy and sell the ETFs, and that's it. Your investing is done for the year.
Well, no, I mean that's the key. I mean, I sometimes I think we need to be explicit because in our industry, the words like easy or hard or are thrown around so flippantly. It's important to highlight, this doesn't take a lot of time. So if someone, let's say, is investing 100% of their money through a passive strategy like the one we're talking about today, this could be good for someone who just wants to live their life, raise kids, go to, do whatever whatever works for them, and they can spend, less than an hour a year on their portfolio, right?
Yeah, I totally agree. And, a lot of people will pay financial advisors to do this for them. Paying a financial advisor can definitely eat in your returns. A lot of financial advisors charge 1% of AUM. Not to say that financial advisors are a bad idea. I think for a lot of people, they can make sense. A financial advisor can help coach you when the market's doing poorly. They can also add a lot of other benefits beyond just asset allocation investing. They can offer you tax advice. They can offer you estate planning. But let's strip things away and say, like, I'm a DIY investor. I don't have a financial advisor. And this is something an individual investor could have a brokerage account and completely do themselves and not have to pay that 1% AUM every year to a financial advisor. And I think that's another key benefit. And there's something that they can do. You don't have to watch the market. You don't have to worry about what's going on with the economy. You know that no matter what, you've got built-in protections under different economic environments. You've got inflation protections built in there. You've got drawdown protections built in there. And you've got some asset classes that ought to deliver a pretty good rate of return over the long run. And it's the kind of portfolio where you can sleep at night and it doesn't matter. It doesn't matter what the headlines are in the Wall Street Journal tomorrow. You've got it covered. You're not going to have the best returns. You're not going to set the world on fire, but you're going to get a good rate of return on your savings and you're not going to have to pay a lot for it.
So I want to expand our discussion a little bit by throwing in a challenge for you here on this idea of using kind of a 60-40 portfolio. So you have a decent percentage in long-term bonds, whether that's the TIPS or just normal U.S. Treasuries. Have you considered how your backtesting was impacted by this long-term bull market in interest rates consistently going down? And it would appear to me that you don't have another 5 or 6% further to drop in long-term interest rates. So, I mean, if you think about in 2000, long-term interest rates were at 6%. Now we're talking about, who knows what it'll be when this conversation comes out, but 2% or, 2 to 3%. So have you thought about how we just don't have as much leg room for continually dropping interest rates and how that might have driven the performance of this type of portfolio?
Yeah, so a 60-40 portfolio right now faces a lot of challenges. And I'd say the big challenge of the U.S. 60-40 portfolio right now is that your U.S. stock valuations are really high and your bond yields are very low. And you're right. I think that the performance of a bond portfolio since 1980 has been, inflation has been coming down, interest rates have been coming down. Not only that, but you could have bought bonds in the early 80s that yielded 15-20%. And if you bought and held a 30-year bond from 1981, you outperformed any investment strategy with almost zero volatility.
Yeah.
So, yeah, you're right. I think the bull market in bonds has really boosted the returns of that 40% bond portfolio. You also had a great situation in the early 1980s where the CAPE ratio was in the single digits. So U.S. stocks benefited from multiple appreciation from 1980 through 2000 that helped a lot. You also had a lot of multiple, after they did poorly in the 2000s, you also had a lot of multiple appreciation this decade where they went from about 15 to around, the CAPE ratio is around 30 now. So you're right, that's a concern. So for the bond piece of the portfolio, the way I look at it is, yes, long-term bonds are only yielding 2% right now, but I'm not owning bonds for the return. I'm owning them more for how they're going to perform when stocks go down or the U.S. faces serious economic turbulence. So those bonds will still go up if U.S. stocks go down significantly. Right now, interest rates are 2%, but I could easily see the Fed going to 0% rates again, or maybe even negative interest rates if we do face that kind of downturn. At the same time, if prosperity continues, bonds will do poorly, but the yield on those bonds ought to go up. Meanwhile, I think the equity slice is going to continue to do well. So those REITs are going to deliver 4% dividend yield. I think U.S. small cap value ought to do probably at least 7% over the next 10 years, because no matter what's happening to valuations for the total U.S. stock market, U.S. small cap value, you're systematically buying and selling stocks as their multiples are changing. You're buying compressed multiples, you're selling expanded multiples. You're doing the same thing internationally. One of the great benefits of international stocks right now is, unlike in 2007 when international stocks were very expensive, right now international stocks are at those kind of early 80s valuations. They're cheap. You have a lot of single-digit CAPE countries that are out there. You're also entering them from a period of time where the U.S. dollar has been very strong this decade. If history is any guide, that's probably going to weaken, and that's going to boost those international returns. And I think the other way to think about it is your traditional 60-40 portfolio. While that's going to be under pressure over the next 10 years, the question is, can we do any better than that? We only have a certain available menu of investment options that are available. If you're not going to do 60-40, where are you going to put your money? You could tilt towards the more riskier things, but I don't think that there's some kind of there's a way that you can really avoid the world we're entering, which is a world of low returns. So I've pretty much accepted, yes, returns on your traditional 60-40 are going to be poor. I think I'm going to do a little bit better than that as a benchmark with my passive portfolio, just because I think things like small cap value, international small cap value, and REITs are going to outperform market cap weighted U.S. equities. And that's the thing, like based on what that 60-40 portfolio is going to return, which is probably going to disappoint a lot of people. I know that pension funds out there, they expect to earn 8% on their 60-40 portfolio. That's ludicrous at these valuations and these interest rates. I would expect maybe a 60-40 portfolio to do maybe 3% over the next 10 years, I think my portfolio ought to be able to do 5-7% in inflation adjusted returns. And that would be an outcome I'd be happy with. I'd still get a decent rate of return over inflation. I would still avoid drawdowns, and I would still be able to grow my savings.
So I think that was a very good nuanced answer, coming at, recognizing there are some challenges. But you made one statement in there that you're not buying bonds for their return. And I think as a value investor, which we both claim to be value investors, it's kind of a tough statement to realize because you're really focusing on trying to manage that volatility. So while I understand that, what I want to know is there a cutoff point where, so we talk about long-term bonds are yielding, let's say 2% now. Is there a point at which you would not own long-term bonds? Is there a point where, if they're yielding 1% or 0.5% or they're yielding 0, where would you say, you know what, it might reduce my volatility, but this is not worth owning?
Yeah, and that's a good point. And it's like I said, the main reason that I own it is because I know that bonds are going to cushion a serious drawdown. Like if we have a 2008 scenario, or God forbid we have a 1930 scenario where stocks go down by 80%, there's no place to hide, your bonds will at least be flat. I would also point out that it's not necessarily about the nominal rate on those bonds. It's also about the real rate of return on those bonds. There have been periods of time when bonds haven't yielded a lot in real terms. Even though the nominal interest rate may have been high, the inflation rate was also high at that period of time. I would not own bonds, I would say, if the yields went negative. I think that that's really difficult to justify. At that point, you might as well just hold cash. It's going to cushion your drawdowns. You won't earn anything on it, but it's better than getting negative interest rates. So I'd say that would be the cutoff for me. But no matter what happens, bonds ought to cushion a drawdown, and that's really what I want to avoid. I want to avoid an 80% or 50% drawdown in my savings.
Okay, so if bonds were negative, which we are both in the U.S., and you kind of think about in other countries, bonds are negative. So it's something where some of my foreign listeners are going to have a different decision that they're going to have to make. So would you just expand in that circumstance kind of the three categories you already have that are equities, kind of just build up more REITs, more small cap value, that sort of thing?
Well, I'm also conscious of the fact that we might have a significant drawdown. So I would say if rates went negative, I would just hold cash for that 40%.
Oh, okay. Gotcha.
Allocation rather than invest in the actual negative yielding bonds, because you still want to have a nice cushion there when you have a drawdown and you have something significant happen, and that we might have something very soon where we could have a pretty significant drawdown, and even in those core equity categories of small cap value, international small cap value, and REITs, they will go down with everything else. I think it's a better place to be than market cap weighted U.S. equities, which are very expensive and very tilted towards some very expensive momentum stocks. But at the same time, if we face a really serious situation where unemployment is going through the roof and we're having serious economic problems, those asset classes won't be a place to hide. When you look at the world, what's happening in the world right now where interest rates are going negative, it is a really crazy experiment, and it defies all logic. The only way that would make sense would be maybe if the market was anticipating deflation to occur in the future, where you actually expected prices to decline by more than the bonds are yielding. That would maybe be the only logical way that it would make sense. But I don't think that's what's going on. I don't think it's a rational situation that's happening in Europe right now. It's definitely a cause for concern. It's definitely weighing down interest rates in the U.S. because international investors looking for a place to hide are seeking out U.S. treasuries, and that's probably depressing our yields. It's also giving our government the ability to run up bigger deficits than they would normally be able to. That's another troubling thing about owning these bonds. So we're definitely entering a new world. I would like to be able to just say, yeah, I'll stick to my 20% 5-way allocation, but obviously things are changing, and there is a point at which I would say, yeah, I'm not going to own these things. This can get pretty crazy.
So, but just to clarify, you're not making necessarily macro projections. You're not projecting that like, oh, deflation will happen or deflation won't happen. You're trying to build a portfolio that can manage different scenarios. Is that accurate?
Yeah, that's 100% accurate. My goal is to have a portfolio that ought to deliver return in most economic situations with a lot of built-in protections. And I'm not trying to make a prediction about where the economy is going, where international stocks are going, where U.S. small caps are going. I have my biases, I have my opinions, but the whole idea of a balanced asset allocation that's rebalanced every once in a while is that you're not trying to predict the future, and it shouldn't really matter what happens with the future. But that said, negative interest rates on U.S. Treasuries would probably be a game changer that would make me want to reconsider that whole allocation. But that's pretty much the only thing that could make me go ahead and change that up.
So I want to kind of focus again on, you mentioned a few minutes ago talking about the different outlooks for what we think passive portfolios should return going forward. And you mentioned that you think that they're going to be lower in the future than they have been in the past. As you are seeking financial independence, how does that play into your mind of, besides kind of the portfolio that you're recommending, that where you think you can manage some of that, even you say that it's going to be lower than it was in the past. So do you think, as someone seeking financial independence that's listening to this podcast, is their solution simply to save more money, kind of read books like Your Money or Your Life where it talks about some of those principles, or is there a way other than just saving more money to handle that?
I'd say there are two big things that they need to do. Yes, the returns on most asset classes are going to be less than they were in the future. If you look at valuations and you look at interest rates, with the exception of international stocks, they're cheaper than they've been in a long time. And yeah, I think the best things that someone can do is pursuing financial independence is to save more money, probably take another hard look at the 4% rule, where you want to have 25 times your annual expenses saved up and then live on the 4%. That might not be an optimal approach. You will probably need more than that. And then the other thing you can do is what we've been talking about, which is diversification. A lot of the people pursuing financial independence, when you read the blogs and you read about their approach, it's 100% U.S. stocks. And I really don't think that they're totally conscious of the risks that are embedded in that approach. You look at most valuations, they're at all-time highs right now. It's possible that U.S. stocks may have another negative or lost decade. And I don't think that they're considering all that risk that they're taking. So yeah, I guess in short, the answer is save more money and try to become more diversified, so you're not as exposed to the valuation compression that's probably going to happen in the future.
Okay, so last question for you. Is there anything that I should have been asking you about your passive strategy that I didn't? And are there any other books that you might recommend someone read, or maybe a podcast someone listen to learn more about these strategies?
Sure. Yeah, the only other thing I'd add is that I think ETFs are the optimal way to do things instead of mutual funds. With ETFs, you only need to pay taxes when you sell it. So that's a big advantage. In a mutual fund, you can wind up paying capital gains on distributions that you may not have even experienced as an investor. You get it when the fund sells it. You don't get it when you sell it. So I think ETFs are a really optimal way to do that. The other thing is the importance of fees. Jack Bogle, he invented the index fund. He created the first index fund, but I think everybody is focused on his contribution in terms of market cap weighted stocks. But I think one of his big insights was that fees are such a major inhibitor of future returns. For most of the asset classes that I'm talking about, you can own most of them with less than 10 bips. If you avoid funds that charge high fees, you can do a lot to enhance your long-term returns. Even a 1% fee over the long term can really dramatically lower your total return. So those are the big things I'd say. You want to focus on ETFs, you want to focus on lowering fees, and you want to focus on taxes. Those are pretty big things. In terms of books that I'd recommend, a big influence on me was Unconventional Success by David Swenson, where he talks about asset allocations. He compares different buckets of different asset classes and how they return and how they can help you in a portfolio. In terms of books that are out, the other books that I'd recommend, William Bernstein, he has a lot of really good books about asset allocation. And last but not least, I'd say you could experiment with different allocations on your own. A great resource is portfoliovisualizer.com. You can go in and you can backtest different asset allocations. You can see how they'll do. The Boggleheads Forum is another great resource. When I wrote a blog post about asset allocation, I used a backtesting spreadsheet that a user created on that forum. It's called Simba's Backtesting Spreadsheet. That's another great resource. And an excellent resource that's out there is a blog called portfoliocharts.com, where the author goes through different kinds of asset allocations, lets you see the benefits of those, lets you visualize what those returns look like. And another great thing about that website is he has a number of tools on there that help you visualize exactly what those returns look like. You're not just looking at a CAGR and a drawdown and a standard deviation. You're seeing how that much different portfolios return from different start dates. There's another tool where you can look at the maximum and minimum returns and kind of how lumping them in a portfolio can minimize the noise of the portfolio. And you can compare it on different measures. Like he has one on there called an Ulcer Index, where you see how stressful that portfolio is to maintain. And I'd say those are the big resources I'd recommend.
Awesome. Thank you for coming on the podcast.
Yeah, thanks for having me. It's always a great time.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.